Hi guys, welcome back to another video, and the purpose of today's video we're going to run through the advanced Gartley pattern. So if you go to my website ottrays.com, on the patterns tab at the top here we've got all of the advanced patterns and all of the harmonic patterns. Under each one you can find a video of their description and also the image here of the description and the trade setup and how to run through identifying and setting up the trade for each of these patterns. So to get straight into it, as with each pattern we start with our initial X to A leg. This leg's not determined by any Fibonacci levels yet, so it is just an initial price swing. Can be in any direction, but it determines whichever direction this X to A leg is in determines the final reversal of the pattern, so which direction we're looking for the reversal in. So if the X to A leg is bullish, then we're going to look for a bullish reversal. Again, if it's bearish, then we'll look for a bearish reversal. So that X to A leg is just an initial price swing. The next leg is the B leg, obviously, and for the Gartley, the market forms the B point if it touches at least a 618 retracement of the X to A leg and does not touch 786 retracement of the X to A leg. So at least a 618 retracement of X to A. So we can get our Fibonacci retracement tool, drag it from X all the way up to the A point, X to A. So at least a 618 retracement and does not touch 786. So we're looking for price to enter this zone here. Mark this with a red box. This is going to form our B point. So price has to exceed at least the 618. Now the wick can exceed this, so the price can float below this 618 level and then the candle can actually close above it. This is still valid, so even though the candle's closed above it, the price has still entered this region and the wick will be within this region, will be below the 618 level. But the wick cannot exceed the 786, so the wick can come all the way down to here, come close, 1 pip away from touching that 786 level. So long as it doesn't exceed it, then that is still a valid pattern. If the wick exceeds it and the candle closes back within here, that's still invalid as price has exceeded this level. Unlike up here, the wick can exceed and close above, it can't do that down here. So long as price comes within this level, that will form a valid B point here. So if I just type this up, this is our B point. Now moving on to our C point. The market forms a C point if it touches at least 618 retracement of A to B and does not exceed A, or 100%. So stretch our Fibonacci retracement tool from A to B. Again, a 618 retracement of AB and does not exceed A. So we're looking for price to come up to at least 618, this green line here, and cannot exceed A, or 100% retracement of this A to B leg. So we're looking for price to fall within this red box again here. And the same rules apply as our B point. So price can exceed that 618 level and the candle can close back beneath it. So long as the wick comes above this 618 level, so long as the wick exceeds it and the price moves back below and closes below it, that price has exceeded the 618 level, therefore it's still valid. And again, that 100% level, or the A point, price cannot exceed that. So if the wick exceeds this and comes back down to close below it, that's an invalid pattern because price has exceeded this. So the wick can come in here and close below, but it can't do that here. It's got to go within this range. So that forms our C point. Finally, the D point of the pattern. The market forms a D point completion by fulfilling a 127.2 extension of A to B leg. To get our extension tool, go from A to B, back up to A. From our previous one, sorry, 1272, extension of A to B. This is our D point here then. So again, so long as price hits this level, so conventionally we'll set limit orders at this level. Once that price is hit, the pattern is complete. So if I type this up here, and draw it out properly for you. So once price hits that 1272 level, that pattern is now valid, complete pattern. So we'll join these up. And that is our Gartley pattern. Now, stop loss levels. So Gartley's stop loss goes at the 113 extension of the X to A leg. So it's going to go below X. So we take that extension tool again from X to A. And we're going to need that 113 that I just got rid of. Take that off, 113. See the 113 of X to A is below that X leg. And this is going to form our stop loss level. So this is where the pattern is invalid. So the pattern is no longer valid, therefore we want to get out of the trade and cut our losses. Because at this point we're saying that the pattern is no longer valid, so that reversal is now unlikely to happen because we've continued lower. We've had our opportunity from the D point down to this level to reverse. It hasn't done that, therefore we're no longer expecting this to reverse, we're expecting it to continue lower, so we'll just cut our losses and get out of the trade at this point. In the instance that price does reverse, we're looking for a 382 and 618 of the AD retracement. So stretch our Fibonacci retracement tool from A to D, and we're looking at a 382 for our first targets and the 618 for our second targets. Now for these targets, again, same as most other advanced patterns, that 382 is our target 1, and once we hit that 382 level, we're going to close off half of our position. So once half of our position is closed, once we hit that 382 retracement level, we'll then move our stop loss up to break even, so up to that D point, the original limit order that we've set. We'll close half our position, move our stop loss to break even, and see if price continues to that 618 level. So if price hits that 382, price can now either come back to here, and this is our lowest point then, and it will cut us out at break even or 0. So we've already secured our first target's profits at the 382. So we've locked those profits in, and then price could reverse and cut us out at 0. So we've just won profit, or it could continue higher and take our second targets, and then we'll be have 2 profits hit there. If price continues lower before reversing, so if price hits this D point, our limit orders then hit. So we're in the trade, we're expecting the trade to move higher, but price does in fact move slightly lower before reversing. You need to stretch our fib retracement tools. We need to stretch them with the price, so we need to stretch them to the price extreme. Our price can move all the way down to 1 pip above our stop loss. We still need to re-stretch those fib retracement levels. So if price moves down here and then reverses, we're no longer looking for our original targets here. We're looking for targets to be here and here. You see they're slightly lower now. But these fib retracement tools are meant to be a retracement of the entire swing. That's why you have to re-stretch them. They're not going to stay there because price that's no longer the swing point, is it? At this D point, price has continued lower, so we're looking for a retracement of the entire swing from A to D. I hope that makes sense. For those more conservative traders, you could treat this as a buy zone. Let me just put everything back to normal. So you can treat this area between the D and the stop point, stop loss level as a buy zone. So for those aggressive people, you're going to set limit orders at the D point and expect it to either hit the targets, move stops to break even and hit the second targets, or just straight away hit your stop loss. That's what you're going to be looking for. For those more conservative traders, you could wait for price to come into this level. So if we have a large bearish candle close below the D point, you're not in the trade because you didn't set any orders up. So the bearish candles close below this, then we get another bearish candle and price moves lower and lower and lower before eventually might put in a double bottom you could then look for an entry on that double bottom and look to enter here. So now your stop loss remains the same at that invalidation level, but your risk, your reward is still at the 382 from here. So we've stretched the price down to those swing, but because you've minimized that stop, you've only got a 6.6 pip stop, but you've got 54 pip reward. So a massive risk to reward ratio. So you could use that if you're more conservative. Test it out different ways, see which wave work better. That might not work as often as the limit order, and that might benefit your personal style of trading and match your psychology. But yeah, that is the Gartley pattern. So that's everything you need to know about that. Check out my website for the free breakdowns of each pattern and all of the videos for each pattern as well. Yeah, I hope this was informative for you guys, and let me know in the comments if you'd like to see more of these. Thank you very much for watching. Cheers, bye bye.